Hello, my fellow Americans. This is Brant Spessart with Steward Wealth Strategies. And I just want to say thank you for tuning in for a couple minutes as we talk about investing in an election year. We're sharing this piece with you that was produced by Capital Group that specifically talks about what it's like to be an investor and some of the concerns that many investors have during an election year. So I'm just going to walk through some highlights, but this would be a great piece to invest some time and read through. But how to invest with confidence during an election year. I think we can all agree that there's going to be a lot of headlines, a lot of volatility, a lot of concern over the next few months. But presidential elections can be divisive and unsettling. And at times, the fate of the world seems to hang in the balance. But when it comes to investing, do elections really matter all that much? Overreacting to short-term volatility during election cycles can be detrimental to investment returns. So Capital Group worked with some top advisors to discuss some questions, and they looked at the analysis over 90 years of investment data, which covered 23 different election cycles. So U.S. stocks have trended up regardless of whether Republican or Democrat won the White House. Primary season tends to be volatile, but markets have bounced back strongly afterward. In fact, stocks have returned 11.3% in the 12 months following primaries. Investors often get nervous and move into cash during election years. Net asset flows into money market funds have been more than twice as high in election years as they are in years after elections. But staying on the sidelines has rarely paid off. It's time, not timing, that matters the most. The S&P 500 index had negative returns in only 2 of the last 20 election years. That was in 2000 and 2008, and both declines were largely attributed to asset price bubbles rather than politics. Which political party has been better? Investing during election year can be tough on the nerves, and 2024 promises to be no different. Indeed, politics can elicit strong emotions and biases, but investors would be wise to tune out the noise and focus on the long term. That's because elections have, historically speaking, made essentially no difference when it comes to long-term investment returns. What should matter more to investors is staying invested. Bottom line, U.S. stocks have trended up regardless of whether a Democrat or Republican won the White House. What typically happens to the stock market? Markets hate uncertainty. And what's more uncertain than primary season of election year? As candidates spend months debating key issues, the range of outcomes can feel daunting. But the volatility is often short-lived. After the primaries are over and each party has selected its candidate, markets have tended to return to their normal upward trajectory. Patient investors who stay the course have often been rewarded. Since 1932, stocks have gained an average of 11.3% in the 12 months following the conclusion of the primaries. But keep in mind, these are just averages. Investors shouldn't try to time an entry point into the market. Instead, a long-term approach can help investors withstand volatility and feel confident that markets have tended to move higher over time, even in election years. Bottom line, primary season tends to be volatile, but markets have bounced back strongly thereafter. So which sectors generally do the best? It'd be great if there were go-to sectors to invest in every election year. But unfortunately, investing isn't that simple. Every election cycle brings its own parade of candidates with their own policy agendas, so market winners and losers are hard to predict. Regardless of who wins, stocks with long-term fundamentals will often rally once a campaign spotlight fades. This pre-election market turbulence can create buying opportunities for investors with a contrarian point of view and the strength to tolerate short-term volatility. Remember, we've said this before, volatility is the price you pay for long-term growth. Bottom line, election year volatility can create buying opportunities for long-term investors. What mistakes do investors often make? If you're nervous about the markets in 2024, you're definitely not alone. Presidential candidates often draw attention to the country's problems, and campaigns tend to amplify negative messages. So it's no wonder that investors may start feeling a little pessimistic too. This can be a problem if they allow their mood to affect their money. But market timing is rarely a winning long-term investment strategy, and it can pose a major problem for portfolio returns. On this next page, they'll take a closer look at how it may negatively impact investor wealth. But the bottom line is investors often get nervous and move to cash in election years, but that's rarely a winning strategy. So what's been the best way to invest? Spoiler alert, the best way to invest in election year has rarely been by staying on the sidelines. To verify this, Capital Group looked at 3 hypothetical investors, each with a different investment approach. They then calculated ending value at the end of their portfolios over the last 23 election cycles, assuming 4-year holding periods. The investor who stayed on the sidelines had the worst outcome 17 times and only had the best outcome 3 times. Meanwhile, investors that were fully invested or made monthly contributions to their 401k, for example, during those election years, came out on top. The bottom line is, again, staying on the sidelines has rarely paid off. It's time, not timing, that matters most. So, key takeaways. Election results have had very little impact on long-term investors. History shows that markets have risen whether a Republican or Democrat has been in office. Markets have been volatile during primary season, but tend to rise strongly thereafter. It's important to stay the course through primary season to benefit from any potential rally once the final candidates and eventual winner emerge. Investors often sit on the sidelines during election years out of fear and uncertainty, but that's rarely a winning strategy. Net asset flows into money markets have been twice as high in election years as they are in the year after an election. Investors who were fully invested or made monthly investments continued to invest generally did better than those who just stayed in cash. The key is to avoid timing the market around politics. Thank you very much. God bless you. Know that if you ever have questions or concerns, our wealth management team here at Steward Wealth Strategies is available. It's an honor to serve you, and thank you so much for your trust.